Welcome back to Bring It Home, the show about reindustrialization and the American manufacturing renaissance. Today we have a special treat. Our guest, Seth Holm, is here, an expert in transportation, especially publicly traded transportation companies. And he'll be discussing some headlines with me, and then we'll also get into his fund, Westborough Capital, and how he thinks about transportation today, sort of in the midst of a pretty large and, how should I say this, escalating trade war. All right, so Seth, I pulled some headlines for us to talk about. The first one is a really, I think, big and good one. Johnson & Johnson announced that they're planning on investing $55 billion in the U.S. over the next 4 years. This represents a 25% increase over the previous 4 years. So, a decent increase in sort of CapEx, in American CapEx. They broke ground on a plant in Wilson, North Carolina, that will be producing cancer drugs and other medications. This is kind of coming in the context of, like, obviously large announcements from companies in a number of industries, but particularly in pharmaceuticals. We've seen a bunch, most of them having to do with like GLP-1 drugs or other sort of like biologics. Interested to kind of get your take on Johnson & Johnson and just this announcement, and if you've read about any of the other pharmaceutical things that have popped up.
Sure, yeah. Definitely not an expert in pharmaceuticals, but I think it's part of a larger plan for the tariffs. I believe President Trump, he believes that, and factually, I guess we could debate how much, but a lot of jobs, middle-class jobs, have been offshored to China. And then there's national security concerns around our ability to procure medicine and pharmaceuticals in the event that we get into a war or even a trade war with them, should they decide to cut us off. So I think that's part of the decision here. I guess what I would say is there's been a number of these announcements. They do take time. I guess what worries me as an investor, while that's a 4-year capital investment, right now we're seeing economic growth deteriorate rapidly from the immediate effects of the tariffs. So while there's no doubt that these are good medium to long-term initiatives, from my point of view, and the stock market being down a lot, which I'm sure we'll get into, these things are going to take time. And, while it's a big number, the U.S. stock market, I believe, as of yesterday, had lost $6 trillion in value in like 3 days. And so, I think you get into an argument of the pros and cons. So, for example, also, when you look at our trade imbalance with China, I believe we have a $300 billion trade deficit with China. And again, when you measure it against these numbers of potential, economic contraction, job losses, et cetera, you get into a debate about, is this the best method to do it? But certainly encouraging to see. I mean, I guess I recently read an article in the Financial Times, and I've talked with a few investors about this, but it said ships are the new chips. And the idea was, so as you well know, and everyone largely this audience would know, probably every single good that you get 90% plus comes in on a container ship, of which about 90% are owned by China.
Yeah.
And then, so they can literally, quite literally cut off our everyday existence should they decide to. And then the article also spoke to the fact that that we can't even procure our military supplies without Chinese container ships. And then you've got the whole other Arctic battle for Greenland and other things. So anyways, I think it's a really probably a positive development, one of many. And, there's been a lot of them, as you mentioned.
Yeah, this one does seem to be more motivated by the tariff stuff and the protectionist policies that the Trump administration has implemented. The GLP-1 stuff just seemed more about just like market growth opportunities, but this, I think this CEO actually like called out sort of how lots of companies were demonstrating their faith in America or whatever by making these big announcements.
Yeah.
Cool. Second headline: a startup called Nearshore has launched. Nearshore is a apparently AI-powered marketplace of suppliers for manufacturing. So basically, what they do is, and this network is across the U.S., Latin America, and the EU. And basically, what they're doing is connecting businesses to about 2,200 factories that they have in their platform, helping people source goods in different parts, different kinds of expertise in production capacity when they need it. It's kind of interesting to see this thing pop up. It's certainly seems like now's the right moment when so many companies are being forced to re-engineer their supply chains very rapidly and figure out, kind of scramble to figure out how to avoid the worst of these tariffs. I don't know. Any thoughts on Nearshore?
Sure. Yeah. I mean, I think the concept, I don't know much about the company itself. I've never researched it and I don't know.
Yeah, it's
don't know the executives, but the idea makes sense to me. And my mind shifted to, I'm sure you saw something. Paradoxically, GM and Ford have some of the most, particularly GM, have some of the most tariff risk because so many of their cars are built in Mexico. I believe the number's around 40%. But the Wall Street Journal did a big 10-minute video on how complicated it is to actually, and there are also a lot of regulations with autos. I listened to a long interview with.
Are you talking about regulations in the USMCA or?
Yeah, you can't just move a factory overnight, even if you had the hundreds of millions or billions of dollars, because the cars need to be manufactured perfectly and safely such that they're ready to go out on the road. But just using the Wall Street Journal's example, I mean, I believe an EV has around 30 parts. That's one of the total. Whereas an internal combustion engine ICE vehicle, the F-150 has hundreds or thousands of parts. And even if you look at a piston, if the final assembly of the piston is in the United States, a lot of times it has 7 cross-border moves just from the underlying components. And so,
sure. And I know that there are also like complicated things in the USMCA where it's like, is the vehicle like 40% like built in the US, or is it 65%, and like are you measuring this by like weight or dollars, or like those sorts of things come into play as well?
Yeah, so look, I think the value proposition, if they can deliver, is incredibly compelling, because I think there's a ton of CFOs and of both public and private companies, looking to do just that. And I'm sure it's not. I'm not doing it myself, but I'm sure it's not easy. You may not even know in certain cases. And so, a company like that, to the degree that they can make it more efficient or cheaper or easier, certainly a compelling
it's interesting. There has to be a big opportunity for them. It must be though a small subset of all of the decisions and moves and supplier changes that are being made. I can't imagine that GM is just, going online and doing a search for like who can make like some critical component that they need. So there has to be like a subset or a space of companies that are buying like relatively commoditized pieces of whatever.
Yeah, probably
widgets.
I don't think GM is probably going to be using nearshoring, but like maybe more a small, medium-sized business that's confronted with the same challenge I just metaphorically. Yeah, I think you're right though.
And the last announcement, somewhat similar. Iron Prairie Ventures, a new venture capital firm, raised a $15 million fund focused on pre-seed and seed stage investments in, quote, startups fueling the industrial sector's digital transformation. And they kind of mentioned that some of the sectors that they're focusing on include construction, manufacturing, infrastructure, logistics, and supply chain.
Yeah.
So this is another one of those sector-specific VCs that puts the word iron in the name of the firm and wants you to think of these like mid 20th century like metal foundries and like with like molten steel and like sparks flying everywhere, but you know probably going to be funding software companies if I imagined
Yeah.
the digital transformation of the industrial sector. But anyway, thoughts on Iron Prairie Ventures?
Well, I think it makes sense. At least it's, I guess President Trump's been in office for what, three months or so. He's going to be there for, another three years and 9 months. And, he seems quite emboldened the second time around, and he's not worried about being reelected. As we can see, I'm actually quite shocked that he was, he used the stock market was kind of his measuring meter for his performance. And I was a little shocked that he was willing to take the market down by 20%. So I think, over a multi-year time frame, it certainly makes sense. And my guess, and again, I'm a public market hedge fund investor, but I would guess that venture capital is going to become harder to come by if it already isn't. And so at least it's in jive with where things are going, at least over the next few years. So it makes sense. As far as the name convention, I mean, look, I see the same thing in public companies all the time. Last year and the year before, companies that hardly had anything to do with AI either changed their name to something with AI or referenced AI on their conference call dozens of times to try to, you want to get painted with the brush when there's strong momentum and price rises behind it. So
that's interesting.
Nothing wrong with that, I guess.
We'll talk in detail about equities markets here coming up, but I've been honestly I don't know whether have put my head in the sand with regard to my dwindling retirement accounts, or I'm actually just kind of sanguine about the pullback. I was looking around and I noticed that looking at historical data, and it turns out that Apple stock, right, which one of America's most valuable companies, if not the most valuable, has had 17 separate 25% pullbacks since its IPO.
Yes, that's the problem with it. If you put $10,000 into XYZ, you'd have $100 million. But even Berkshire Hathaway itself has had half a dozen 50% pullbacks. So holding is a lot harder than you think.
Yeah, holding's a lot harder than you think, but also the stock market is volatile. It's
the price of
driven by momentum.
The price of entry into equities. That's for about 15 years. The equity risk premium. The reason why you earn a premium relative to bonds and safer investments is because of the volatility, and you're putting your capital at risk. And I think a lot of people, kind of, particularly with retail and options and everything and meme stocks, kind of forgot about that. With zero, we had 15 years of zero interest rates and passive flows into some of the companies you mentioned. And stock markets do not. The U.S. stock market has gone up by 10% a year on average, nominal for like 150 years. But
that doesn't mean that it goes up 10% every year.
Right. You can get into the stats, and just to keep it simple, I think you should expect a 10% peak to trough pullback every single year in the stock market, a 20% once every 3 years, and something greater than that, like once every 5 or 10 years. So it's normal, and part of it. Emotion is it makes my job really difficult because when you manage other people's money institutionally, you get under performance pressure, and so you want to it's a delicate balancing act between trying to do smart things long term for yourself and your investors, and not panicking. But I would say the good thing is, so for the first time in years, I'm seeing some really compelling values. Just getting into.
There we go.
We're going to get into it, but after a 3-year freight recession, all of these trucking stocks on average are down 25-30% year to date
Nice.
after a horrible 3 years. So I think you can make the
There's
case.
deals out there.
Well, I mean, you got to caveat it heavily, and we can continue to talk about this. But if there's a resolution before, I feel like President Trump is playing a game of chicken, a dangerous game of chicken, such that he's got to get a tariff deal before the economy is wrecked and goes into a recession. And I think we're already, some of the FreightWaves data is already supporting it. It's turning down. We're below like 2023 on OTVI and contract load. So it's getting dangerous, but to the degree that he can get some negotiated tariffs sort of down and done, and then pass some tax cuts, I think, in the back half of the year, it's kind of what I normally tell people, it's kind of hard to fall out of the basement in trucking. So for example, as you know, $1.50 a mile, national average spot rates, ex fuel. What does it cost to haul a mile? $2.
Yeah.
So, I mean, how much worse can it get it? But yeah,
Not
I've
very
seen some compelling. There's some really beat up stuff for the first time in years. So,
well, with that, why don't we step into my office and to continue the conversation?
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half. And then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Seth, can you tell us just a little bit about your fund and what you do?
Sure. We're about 3.5 years old, based here in Chattanooga. We are, to my knowledge, the only pure play long-short transportation fund in the market, in the world. There are people that do variations of what we do, but we invest in anything transportation across any mode, ocean, sea, and air, companies that move passengers or freight or suppliers into those or derivatives of those markets. So it's about 400 companies globally and trillions of dollars in market cap. And we manage with a long short mandate, which I think makes sense because of the cyclicality and the high beta nature of take trucking as a classic example. It's tough to manage a long only portfolio with stocks that go up and down by 5 or 10% and have these 2 to 3 year violent up and down cycles. And so we basically try to take both a top down and a bottom up approach and structure a portfolio that can mute out some of the volatility while taking advantage of the cycles.
Nice. And you've been watching the news recently, I assume. Some things have happened that have affected the stocks in your universe?
Yeah, so I think we're recording this, what is today, April 6th? 7th, Masters Week.
April 8th, yep.
So yeah, as of yesterday morning, we were discussing this offline. The stock market on Thursday, Friday, and Monday, at least through the open and the futures, it was the worst drop, 3-day drop in the U.S. stock market since the Great Depression. And that was from off the back of President Trump's Liberation Day. Yep. And it where he unveiled much harsher and more widespread tariffs on everyone than even kind of the worst case scenario. That has people quickly questioning whether or not the U.S. is heading into a recession.
So the idea would be that the tariffs on all these countries would cause consumer prices to suddenly spike, and people's wallets that have already been stretched by inflation over the past half decade, would basically, you would just see like their demand for more goods kind of crushed.
Yeah,
and then that would just that would trickle back up.
Yeah,
through the like logistics networks and eventually cause transportation providers to be starved of freight.
Sure.
Suppliers and producers to lack purchase orders and. et cetera?
Yeah, I think in general, the tariffs, there's many problems. We're at the end of last year, we were in about the 100th percentile on every single valuation metric that you can come up with going back 150 years.
So the stock market was
It was
extremely
at
expensive.
1999, 2000 type levels. It was extremely expensive. It was probably looking for a reason to sell off. A lot of that was AI and other excitement. I think that, to your point, yes, I think to the extent that tariffs are inflationary, and that seems to be what the market believes at the moment, that would also
they kind of like,
put the Fed on hold, right?
I was talking about this with somebody the other day, and they were kind of saying, the tariffs aren't inflationary, blah, blah, blah. The bigger risk is recession. And, I kind of agree that the biggest risk is recession. And that kind of explains what we're seeing with like bond yields going below, like treasury yields going below 4%.
Yeah.
But I want to note that even if the tariffs work precisely as intended, that still entails, the price of foreign goods going up such that domestically produced goods are more competitive, right? So even if they work like according to like a textbook sort of like old school way of thinking about like protectionism and trade, like that still implies inflation,
right? And I think it's just really the market views it as first of all, you got to separate the real economy from the stock market, which sometimes go together. But if it's stagflationary such that it drags on growth while increasing inflation at the same time, then Jerome Powell and the Fed, he actually came out last week and said it's too early to be cutting. President Trump was, I think, arguing for a rate cut given the fall in the stock market. And then, the knock-on effects to consumers, which are 70% of the U.S. economy, and they've been really, really strong. A lot of that was because of generous fiscal stuff during COVID. But consumer confidence was just a 12-year low, I think, for the March reading, and retail sales have been coming in weaker, and obviously, particularly in things like dry van trucking, that's probably 50% of the freight mix, and same for intermodal, and it's all tied together. So,
yeah, what we noticed sort of in the lead up, like looking at like sonar data and kind of like the basics of the freight market, which are volume, capacity, and price. What we noticed in the lead up to the tariff announcements was that people seem to have been sort of changing their risk calculus and kind of saying, okay, the safe thing to do is to bring stuff to bring goods and inventory onshore.
Right. Yeah.
But you can sort of tell that it wasn't being driven by like urgent consumer demand or shortages or anything like that, because they were choosing the slow, cheap ways to bring
the West Coast intermodal imports, and so
it was all intermodal
tariffs pre-stocking and the warehouse utilizations going up, and
but what I'm saying is like the tariffs pre-stocking saw elevated ocean container and intermodal volumes,
correct? Yep.
Not truckload or air cargo.
Exactly volumes. Right. That makes sense. Yeah, and so if you're a supply chain manager and you want to go ahead and stock up as much as you can, whether it's in the physical store or the distribution center or the warehouse. Yeah, intermodal, we always had a rule of thumb when I worked here, it's a 15% thereabout discount to truckload, and the truckload market is already loose, and at least in the spot market, running at a loss, arguably.
Yeah.
So that's the most economical way to do it. If the sell-through, to your point, the end demand is not running at the same rate such that you're selling through as fast. So that makes sense. And, you've seen it in the ocean container data, West Coast imports, right? Long Beach, et cetera, up double digits. And I've seen it on the Trans-Pacific container rates. They were not at COVID highs, but well below that, but really strong levels for the last kind of 3 to 6 months, and
very strong compared
that taper
to
off a little bit.
Anything pre-COVID, like double pre-COVID rates easily.
Yeah, and highly profitable. And that was actually the whole nother discussion, but there's way too much excess capacity in the container shipping market, and it flummoxed a lot of investors, me included, and it really was helped by the closure of the Red Sea with the Houthis. That really offset this massive backlog of container ships that have entered the market over the last few years.
So kind of going by mode, what do you think about like ocean transportation or ocean freight? Clearly, the big container ship lines may not be the best place to be long right now, but
Yeah, sure. So I think about ocean freight in kind of, I think it's 7 segments. Okay, so I look at crude tankers, product tankers, dry bulk, LNG shipping, LPG shipping, car carriers, and containers. And then within containers, you have the liners and then the container ship owners. And so I guess on the spectrum of, I view everything in a long, short variety because that's what I do. I think on the long side, I would favor particularly crude tanker carriers. There's a couple of reasons for that. One thing, this is a good conversation, but you can really know supply. It's really hard to measure demand.
The price of crude oil is plummeting, by the way.
That's actually good for them, and that one reason why that is plummeting is because OPEC finally increased production, so that's more barrels out there for them to carry. So this is actually a positive for crude tankers. There's 2 companies that are both Norwegian-based, Frontline and DHT, which I think play well into this trend. Those are mainly VLCCs, very large crude carriers. They carry 2 million barrels of oil, mainly from places like the Middle East to China, export nations to import nations in the U.S. to China, et cetera. And in addition, so you've got a really low order book, so supply is growing less than demand. You've had an OPEC production increase recently, which is going to put more freight. The oil is freight for them.
Yeah.
And then last year you had all the dark fleet. So these are Iranian and Russian ships operating, ancient ships operating illegally in the market that China was using, particularly China, but others as well, to import there. And you've had these OFAC sanctions from President Trump cracking down on the dark fleet. So that I would put crude tankers at the top of my ocean shipping list. On the sort of the short side, I would probably go container shipping, assuming they're not locked up on multi-year charters. So you can, just like the trucking, there's a lot of chartering in container shipping. It's not all spot, and similar truckload. But to the degree that you're running heavy spot and you're container oriented, I think you're arguably in trouble there, given
someone like
opposite characteristics.
Someone like Zim or somebody.
Yeah, and Zim has had a really good last few years, but so
they kind of have a little bit of differentiation in their service and what they offer with like these like high speed, sort of like fast, supposedly e-commerce oriented trans-Pacific routes.
Yeah,
that kind of thing feels like super high beta to me in the sense of like when times are good, it's blowing up. When times are bad, like no one wants to pay those.
Yeah, it's a double-edged
spots.
sword. If you're bullish, you want to go long, just like sort of on the trucking side, heavy spot exposure and high operating leverage. If we're in the beginning of an upturn, you want that, and a lot of debt, right? You want that because the equities are going to increase a lot. But I would throw containers on the most unfavorable, particularly because as we will get into more, I mean, trucking has been through a 3-year bear market already, maybe more. And rates are loss making, even almost at the contract level. So
we're still seeing bankruptcies all the time of 50-year-old trucking companies.
Yeah, I mean, capacity's been slow to exit. I've kind of looked at some of the data.
I think we're turning the corner on that, but the rates are still really low and the business environment's still really tough. But we can get into that in a second. What about like what's sort of like a wait and see story on the ocean? If if the crude oil carriers are like a definite long.
Yeah, I mean, there's risk there. There's so a lot of ocean shipping is tied to China as the world's biggest consumer of commodities. I would say dry bulk is wait and see. So dry bulk is mainly moving things like iron ore, bauxite, which is the aluminum input.
What about like
grains?
Okay,
and it's mainly a Brazil to China route and Australia to China route. That market has some really. This is why this is a wait and see. it has, particularly in the larger vessels and dry bulk, it has actually the lowest order book along with crude tankers. So I tend to like to invest in places where I have multi-year visibility into low supply. So it has that working for it. It's been in a bear market for the past, 5 years because there's been excess iron ore inventories in China from a property recession and a lack of building, et cetera. And then there's a couple huge projects coming online in West Africa and Brazil, specifically a Vale project in Brazil and Simandou in West Africa, which basically these two projects, just making it as simple as possible, are going to eat up all of the incremental large dry bulk vessel, Capesize to be exact, supply for that's coming online over the next couple of years. So if you get some kind of a recovery in China, that's going to be, I called it a powder keg in my last investor letter, such that, in 2008, Capesize spot rates got to like over $150,000 a day. And right now you're sitting in somewhere around 20,000. And so that could be your next, let's see how tariffs settle. So I don't have a lot of exposure right there, given the binary. I think the risk is pretty well contained. It's similar to truckload that China's already been sort of in the basement for a long time, but the upside is definitely wait and see. You need to see how these tariffs play out.
That's fascinating. Yeah, and the soy thing, I remember learning about that and how China sort of alternates its seasons of who it gets its grains from. So like in our winter, it's buying soybeans from Brazil. In our summer or fall, it's buying soybeans from the U.S. and it kind of switches those lanes during the year.
Yep.
I mean, if we talk about grains, maybe the natural transition is to talk about rails as well.
Yeah.
What do you think about the Class 1s? I mean, how bad is this for a company like CPKC?
Yeah, so I've been long CPKC. I think they're the best management and the best sort of medium to long-term growth story, given the only contiguous North American exposure. And there's no doubt that in the medium to long term.
So what we're just for everyone's reference, we're talking about Canadian Pacific, Kansas City Southern, a recent merger of Class 1s, possibly the last ever merger of Class 1s that will be allowed by the Surface Transportation Board. But this is a truly massive and a truly North American railroad that kind of goes from Vancouver to Mexico City?
Yeah, all the way down to the Pacific Ocean and down to Central America.
It touches ports on the Atlantic or in the Gulf of Mexico and the Pacific down in Mexico. And then it sort of comes through the middle of the country down the Mississippi River region roughly. But it's certainly a NAFTA play or a USMCA play. And I know that initially when Trump announced tariffs on Canada and Mexico, people were like, well,
yeah,
what's good?
So that was a rough day for that stock. I mean, starting off, the Canadians are grain heavy. Being Canadian Pacific, Kansas City, there is a percentage of their carloads. Those tend to have more grains, and grains are doing well. To your point, Canadian National CNI is the ticker there. If you want good grain exposure, that's a good spot. Looking at the Class 1s in general, and then there's of course four US. There's CSX, UNP, BNSF, and Norfolk Southern. I would say on the Class 1s, break this down as simply as possible, kind of an elevator pitch. They're the most offensive group in transportation. And there was actually a note from UBS today talking about that. So as you know, they've got a lot of diversification, both in terms of their car loads and their customer base, and they tend to be a lot more profitable from an operating ratio standpoint than all other modes of transportation. And and they also tend to be large cap stocks with dividend yields.
No barrier to
low beta and more defensive in a recession. So those are the good things. Then particularly with CPKC, you have this sort of multi-year secular tailwind around nearshoring and reshoring. The stocks have performed. If you want to get into what's performed right now as we're recording, I think the S&P is down around 15% year to date, and the NASDAQ and the Russell, the other two, are down around 20. Rails are only down low single digits for those reasons. Carloads have been positive year to date. I just looked at the
intermodal volumes are still running like 7% up year over year. And
That's the bull case,
last year they were up 8% year over year.
Yeah, so carloads, I was reviewing it before I came in here. They're up like 3% on average, AAR, Association of American Rail, through the first quarter. However, to your point, it's like 8% driven by intermodal. Again, I think the $1 million question there is how much of that is pull forward and how sustainable is that, right? Because that is also feeding off of that West Coast imports that certainly, if we go into a recession, could be at risk, both in terms of carloads and pricing.
And it's also not, the best freight for them. It's not the best freight that they want necessarily.
It's low margin, right? Yeah. So because it might, I think when you and I used to talk and work on all this stuff, it's like 50% of carloads, but 25% of profits, or somewhere in that neighborhood. Being you get the revenue per carload is lower because it's more commoditized. And the other thing I don't like about intermodal is it really needs a pricing umbrella from for-hire truckload before it can recover. So not my favorite spot. I would say in general, I do like the Canadians. Right now at the moment, I do think the OR story, right? One thing that keeps me away is I typically like to look for pretty aggressive upside, and I'm trying to generate high returns. They're kind of more, I call them the treasury bills of the transportation space. They just can't outgrow nominal GDP by very much. And then
they can't outgrow nominal GDP at all. Because
and the ORs, that's the main piece, right? I think with Hunter Harrison and all of them, operating ratios back 20, 30 years ago were, 90%. They had 10% operating margins, and those have gotten down, to 60 or so. And
roughly,
so I don't think there's a lot of low-hanging fruit to pick on the cost side anymore. And so it's more about the long-term growth story, aside from the Canadians with the reshoring, is more about stealing share from truckload, which is going to be difficult to do, certainly in this environment where
when
rates
truckload
are really
is so
low.
cheap. Yeah, that's a good point. So rail's definitely the defensive spot in. Would you consider that in service transportation?
So I think they have very little, the least amount of downside, arguably. Although
probably the least amount of upside as well.
Probably, like in a full-blown Trump bull market like we saw in November when people were really excited, I think they'll underperform all of the other modes, would be my guess.
And now we get to truckload. Like you said, these carriers were flying high during COVID when there was just a massive amount of freight, not enough capacity, and a really high sense of urgency about moving goods that translated into really high spot rates, then really high contract rates. Trucking companies made a lot of money, but importantly, many new drivers, many new small carriers were formed to take advantage of that favorable business environment. But since about 2022, the bottom has fallen out of that market. Way too much capacity was built. Demand or freight volumes pulled back in, and what happened was a pretty, a really nasty pullback in rates. Years and years and years of bankruptcy announcements every week, if not every day. And here we are now in April of 2025. The outbound tender rejection rate is at 6.2%, which is decent, actually really good compared to anything that happened last year.
Oh.
Volumes are okay, softening slightly. To me, the market feels like it's ready for it to take off if something good happens, but something good has to happen.
Yeah, I think if you look at truckload, particularly, we're talking for hire. If we're talking for hire, not dedicated, right?
Yeah.
And not private fleets. It's the highest risk reward play. I would take it from there when the market bottoms, and if we can get some clarity around tariffs and economic growth accelerates, I think it's going to be one of the best places by far to be, and I'm keeping a close eye on that.
And so like
there's so much operating and financial leverage in these business models that
say we get good news on tariffs, we get some substantial corporate and personal income tax breaks, tax
Yeah.
cuts. What truckload carrier do you want to be in?
So I tend to, my favorite two are probably Knight Swift and Covenant, local company. Covenant's a little bit more defensive. Knight's kind of the aggressive play, but also the larger fleet, a lot of spot exposure. U.S. Express acquired U.S. Express, a lot of torque there to a recovery, if you will.
Yep.
So I kind of, I guess Knight has moved into LTL a good bit as well.
You think part of like a recovery story for Knight Swift would be just continued operating leverage out of
Yeah, I mean, so I'm not involved in either company right now, although I have owned them recently. I saw the data deteriorate, and I tend to be a long-term investor when I can, but to the degree that I'm seeing things that I don't like and I see risk, I knew that truckload was at risk going into a trade war.
Well,
reduced exposure. But yeah, with Knight,
as we know, like buy and hold is not the way to make
it's
money.
It's not a buy and hold sector.
These are truckload is an industry that looks like it has cycles that look like this, right? And it's like
classic supply and demand, short cycle stuff.
Yeah, classic supply and demand, short cycle. Boom and bust. Like there are somewhat easy to perceive like sine waves, just that happen in both like volumes, projections, and earnings. And so, these are stocks you have to get in and out of, and you have to use data to kind of know like when the right time to get in and out.
Correct. And I do use FreightWaves data, but I mean, just thinking about it from a high level, like a Knight Swift, so high demand and capacity exiting will drive full utilization. Full utilization will firm the spot market, which will then lead to contract rate increases, which to the extent inflation tapers relative to as it will create really high incremental margins and a lot of earnings growth. That's kind of the idea. And specifically with Knight and Covenant, I mean, I've covered these for many years, and we talked about them here. The way we always talked about, at least in the truckload market, call it a recessionary OR is probably 100, and a boom time ratio is maybe an 80, and LTL and rail are better than that for at least the blue chip players. So if you think about that, just using round numbers, you go from, regardless of what your revenue is, in a bear market, you go from making no money or running at a loss to potentially making 20 cents on the dollar. And having your revenue go up,
swing.
And having your revenue go up by 50 or 100% in the upcycle. So you can create multi-bagger moves. So what I always talk about is we don't really need to nail the exact top and the bottom. As you know, that's really hard to do. We've tried to do that at FreightWaves. Craig Fuller does a pretty good job of it, but it's nearly impossible to perfectly nail every time. But what you can know for certain is, what I can know for certain is, we're closer to the bottom of the freight cycle than the top. That's not complicated,
right?
Since we know spot rates for $4 a mile, and high school GED educated for-hire owner ops were making $200,000 a year running freight in 2022, right?
Yeah.
So that part's not complicated. Truckload is probably it's just more about timing, right?
Yeah.
And I think with respect to even in a recession, what I think is a little bit different this time about truckload is truckload normally would get pretty hammered in a recession, and it tends to be well in sync. We've transportation investors, you would talk about leading as a great leading indicator for the economy. I think COVID kind of threw that traditional relationship out of whack.
Been hammered
such that truckload earnings and revenue have compressed so much that it's going to be more. It's hard for them to go down too much, because you can't. If you're a truckload carrier and a shipper is asking for rate concessions, there's only so low you can go when you're below cost.
Before you run into your operating costs.
That's right.
And all of a sudden you're out of business.
So I'd say sanguine on truckload. With it's more about if you want to be cute and try to time it exactly. I mean, first quarter earnings. Here's how I'm thinking about it. First quarter earnings are going to be ugly. And I think the consensus, at least amongst the Wall Street kind of public transportation investors, is you're going to see a lot of misses and guide downs. But I think that might be a good entry point because given the dynamics that you can't go that much lower and you kind of get that reset in terms of investor expectations.
Then who knows?
And then if you get the positive, some of the
be,
positive tariff resolution, and they could be off to the races. But we'll see.
Yeah, very interesting. And maybe we'll go to the next. We'll go to the most beta or volatile sector of them all, Parcel.
Yeah, Parcel. You know,
you're in FedEx.
I'm in FedEx. Yeah, I'm originally born and raised in Memphis. FedEx is kind of an idiosyncratic cost-cutting story, as you know, the drive and network 2.0 cost transformation. And just for background, I don't know if the viewers would know, FedEx has integrated their networks, and they're also spinning off their LTL, FedEx Freight, in the next 18 months. So I think what I think makes FedEx interesting is
following UPS's lead in that.
That's right. You know, I think those are interesting because there's always been this cloud over them for kind of the last 10 years with Amazon being a big customer. FedEx moved away from them totally. What was it, 5 years ago? And Amazon is now, UPS is now starting to. There's always that, but that's brought, the stocks are cheaper than they've been in like 30 years from a valuation standpoint on trough, arguably close to trough earnings. I think that's the interesting part.
That is interesting.
And, you know, I think I prefer FedEx because they don't have any Amazon revenue to lose. They've got, I think there's a strong argument that FedEx can grow earnings in 2025 and 2026 just from these multi-billion-dollar cost cuts, almost, I don't want to say regardless of the economic circumstances, but under most conditions, they should be able to grow earnings and cash flow the next 2 years. And the multiple is really low. So UPS is a little bit different story. That one's not as enticing to me. I think the stock's cheap and really beat up. It's just it's a much bigger company. First of all, it's got a higher dividend yield. You know, I think they've got some wood to chop there, moving away from Amazon. Sort of, you know, Carol Tomei came in and focused on this high ROIC. Investment capital allocation strategy, hence the divesting.
How did that
UPS
go?
Freight.
Because I remember when she was talking about, she came in and she was saying, you know, we're gonna fix our sort of like volume mix. We're gonna get more into like premium like B2B stuff. They kept talking about like healthcare logistics and stuff like that.
Yeah.
And then COVID hit, and their network was absolutely swamped by e-commerce freight. And I just remember seeing these earnings calls like quarter after quarter all through 2020 and 2021. She kept talking about the strategy, but all the numbers were going in the wrong way. So how did that shake out?
Yeah, it's not great. I mean, the stock performance has been quite bad. I can't tell you. I think the stock is around $100 stock off the top of my head, and it had been 200 as 12 months ago, something like that. I think the higher capital margin and capital allocation story is tough when you have headwinds in your main, to your point. You had a COVID pull forward that they were dealing with, so e-commerce and parcel demand, big turn down, just like truckload. Then they had the unionization agreement, what was that, a year or two ago, that just passed on huge cost increases, and they lost a lot of share to FedEx that arguably they haven't gotten it all back. And then, you know, just recently the stock got hammered because they announced, I think Amazon is a 12, 13% of their revenue. They're going to move 50% away from Amazon by the end of 2026. And that's really spooked people, you know, and kind of created. So I do think it's interesting from a contrarian kind of really way too beat up perspective. But the margin story, I don't think has played out how she would like.
The company is so large and unwieldy.
Yeah.
It's been interesting to see them try to wrangle control of it and actually push it in the right direction.
And arguably on the express division within FedEx and, you know, also within UPS, you're kind of front and center tariff risk in terms of trade. And so not my kind of in the middle, I think the stocks are really cheap and beat up, but it's kind of binary, I guess, around tariffs. I own FedEx because the idiosyncratic huge cost-cutting story.
Yeah, got it. Anything else we should talk about? I mean, should we get into? I mean, there's airlines, there's cruise lines, there's
LTL.
OEMs, LTL. Yeah, why don't we talk about LTL?
Sure. So LTL, let's see. Last year, I think LTL in 2024 did a lot better than they otherwise would have given the bankruptcy of Yellow, which essentially, what were they, the number 3 or 4 or 5 player? I don't remember exactly, but you had a 10% player in the market that essentially handed their freight to mostly the publicly traded, the Saia, Old Dominion, XPO, ArcBest, TFII, right? And they divided it amongst themselves, and that created a volume tailwind at a time when otherwise the PMIs, and LTL tends to be levered to industrial freight, and the industrial economy's been quite weak for the last few years. So I would start there. That's the starting point. We're kind of anniversarying those easy volume gains. And I think the key question with LTL, it's kind of been the darling of the publicly traded transportation market, particularly Saia and Old Dominion, because there's the perception amongst investors that these companies have pricing power, and it's far less fragmented, as you know.
Right.
The top 5 players have like 50 to 75% of the market in LTL. And there's definitely a moat in investor terminology around the multiple billions of dollars in national hub and spoke terminal networks that you need.
The real estate. Yeah.
And so I think there's a perception, accurate historically. The $1 million question is it moving forward, that these companies have much better pricing power than almost anywhere else in freight, and that's been borne out. I think that assumption will be put to the test with the spin out of FedEx Freight over the next kind of 12 to 18 months, because the number 1 player in the market will now, I believe you guys have written articles, they're hiring 300 plus salespeople to try to grow. And so the question is, with the number 1 player no longer focused on margins and increasingly focused, on growth, can everybody continue to grow at nice levels above the market and remain rational?
And we also have that news about Amazon hiring an LTL network.
That's a good point. That really spooked the market. So I believe what was this, a couple months ago? All LTL publicly traded stocks were down around 10-15% in one day. I tend to I don't want to say I totally dismiss it, but I think it was certainly overblown. I think the stocks are more down. They're down a good bit in 2025, but I think that's more about tonnage at most of the LTL players, excluding Saia, which is undergoing a big terminal expansion, has been tracking at like down 10% on average. So I
just wonder like how big of a threat an Amazon like LTL private network would actually be. I remember a similar scare when we actually found out that they were starting to build a freight brokerage, and we were wondering like, oh God, like they've got all of these trucks, like are they going to be able to like basically win all of this freight and put it on their private network and run? And they made some limited attempts to do that, but they actually found it didn't work that well. It was really tricky. Amazon's like internal freight is highly optimized. The dock scheduling is automated. A lot of it's dependent on like the GPS assets in the cabs, and this sort of very like regimented like scheduling and things like that. And like when you throw in like third-party drivers, third-party trucking assets, third-party freight, you're introducing sort of like all of these variables that kind of like made that little walled garden much less efficient and sort of didn't work nearly as well. And so they always had trouble like scaling their freight brokerage to what you would think would be like an appropriate like thing that could move the needle for Amazon, right? And I just wonder like if they build an LTL fleet to serve their needs, they're not going to be moving that like significant amounts of third-party freight on it, I wouldn't think.
Well, exactly. So a couple thoughts there building on what you just said. So I think pricing power in LTL follows service. And if their primary function is handling their own freight, then arguably outside customers would be put behind that. and such that that's going to hard to be have a great service. So that's one thing. I think it's also probably easier said than done. I think you could ask TFII with their experience with UPS freight, how hard Alain Bedard, I think he's called it the rock in their shoe. That's been a really difficult turnaround, and so I think the juice may not be worth the squeeze for a company as large as Amazon when you've got things like cloud computing and AI and retail, which they're completely dominant in. To get into the LTL market is tiny, by the way, right? Relative to truckload. What is it?
50 billion.
Yeah. Whereas private fleet and for hire, you're looking at 800 billion, $1 trillion in the United States for truckload. So it's a fraction. While it's profitable, I don't think it's definitely not their primary focus. I would tend to view it as a buying opportunity if that bear thesis really
interesting
hit the stock very hard.
Seth, thanks so much for coming on the show. I think that's a wrap. We've covered the gamut from the ocean to the crossdock. Thanks so much.
Yeah, thanks for having me.
So that wraps up our episode of Bring It Home. Be sure to visit our website, bringithome.us. Subscribe to our newsletter. Go to our, you can catch these episodes on YouTube or Apple or any of your favorite podcast players.